Hello, I'm Paul Orchowski. I'm here today with Michael Moskal and Scott Lipa for our most recent MG0 17 market update. And with that, we're going to turn it over to Michael.
Well, thank you, Paul, and hi again, everybody. And it's hard to believe we're coming on the close of the year already. For investors, it's been, November and December are the two best months. So hopefully that'll play out this year and we'll get some nice gains in the next couple months here. Today, we're going to talk about three main topics. They're kind of hot topics in the investment industry right now. One is recession. It was a sort of common knowledge, and all the pundits were talking at the beginning of this year about how recession was going to happen, in the first half of the year or at the latest the second half, which we're in now. And that has not happened. So we'll talk a little bit about what we see as far as, are we going to have one? If we do, when would it happen? What does it mean to your investments? The last GDP print that we had, the economic growth that we're having in this country was at 4.9%. So it seems like we're not anywhere close to recession, but we'll talk about that a little bit too. The Magnificent Seven, they used to be called the FANG stocks some years ago, but we talked earlier in the spring about how performance was being driven in the stock market, the S&P 500 index, by just 7 stocks, and that still is the case, by the way. So they make up 28% of the S&P 500. We'll talk about a little bit about what that means to your portfolios. And then the last topic we're going to talk about is interest rates and how it's affecting the economy, what we see happening to the economy over the next year and beyond. First, let's take a look at the market scorecard. Question, are we in a bear market for stocks and bonds? It's been a kind of a tough last couple years. And I have year-to-date performance through October 31st. That's the first column, but then I go back for a couple of years. And, we've been kind of in this mode of, either sideways or declining markets the last couple of years. And really going back to the spring of 2021, the chart on the bottom is the Dow Jones average. And if you took today's index and went across, we're about the same place we were back in April of 2021. So we've been in this kind of sideways moving market for the last couple of years. And which is not totally unusual in cycles, because we went through a time period in 2009 to 2021 where we had a big bull market. Markets were moving up, and anybody who's been around for a long time knows it doesn't always do that. Sometimes we go through what are called bear markets, where we go down and then maybe sideways for a little while before we have another big up move. So you see the indexes are down. The New York Stock Exchange Composite Index, which is all stocks listed on the New York Stock Exchange, that's kind of more indicative of what the stock market is. If someone says, how's the stock market doing? We tend to use that index because it has thousands of different companies in there rather than just looking at just a few. And that's down 1.4% for the year. Bonds are down 4.3%. The S&P 500, which many people are familiar with, again, that's being dominated right now by this Magnificent Seven, the Apples and Amazons of the world. That index is actually made up of about 40% technology and technology related companies. So we kind of look at that as sort of a mini technology index at this point. That's up 9.2% for the year. Our main equity ETF portfolio at MGO actually is up 8.1%. So we've done very well this year, relative to the markets and generally speaking. And that's because we have been overweight in technology, and we do have a fairly high percentage in that Magnificent Seven.
Michael, one thing I would say with that is you mentioned we're basically at 2021 prices. If you look at your 10, 1, 21 column there, my thought is this, and I've been telling people this for a while. I really feel like the market may have bottomed in 2021, but I tell people that we might scrape bottom for a while. And even if we just scrape bottom, the downside risk is low and the opportunity is very high relative to investing now versus waiting to see the market up 10, 15, 20% over the next couple of years. So it's if we've bottomed and if we've already priced in recession, we'll talk about that in a minute. I think the opportunity is between 2021 and now to get money invested, if you're considering doing that.
Yeah, and we don't, of course, no one knows exactly when bottoms are and tops are, but we do know this, that after a big bull market, you're going to go through a time period where you're consolidating as far as prices are concerned, because usually in bull markets, stocks get very pricey and expensive relative to history. And then we go through a consolidation like we've had the last couple of years where valuations come down to more reasonable levels, and then we build on the next bull market. So absolutely, Scott, I agree. We're somewhere in here. Some are going
Somewhere
sideways
there.
for a
We're
couple
like
of
a plane.
years.
We're like a plane landing, right? We may scrape bottom a couple of times, but there's opportunity there.
Yeah, for sure. And we'll
Yeah.
have those times. And the last column I have here is 2019, and you don't want to miss out those usually big up moves we have coming out of bear markets or sideways markets are big. You don't want to not be invested because you will miss out on some of these big gains when they happen. So, and we'll see these up 20 plus returns again. That will happen. So recession or not recession, that's the question. Sorry, Shakespeare. We have what's called an inverted yield curve right now. Now it has shrunk quite a bit, but right now we have an unusual situation, and the red lines that you see on here are those lines that are called inverted yield curves, and that all that means is that short-term interest rates, 3 months, 6 months, 1 year, are actually higher than long-term, and that's unusual because if you invest in something longer term, you're taking more risk, and usually you get more rewarded with higher rates in buying bonds or other kind of fixed income. Right now, we're not in that situation. Right now, you're actually getting rewarded for keeping money in shorter term rates. And the reason being, the Federal Reserve, who is in charge of short term rates, they forced rates higher. The marketplace is on the longer end of rates going out 10 years. They don't believe that we're going to have higher rates going out, 10 years. So the marketplace itself is thinking rates should be lower. So, but anytime we've had this inverted yield curve, it has pretty much, it's about 89% chance that it will precede some kind of economic downturn. Doesn't have to be depression, doesn't have to be some kind of big crash, just some kind of slower economic activity. So we probably think it's probably going to happen. We'll probably see some slower economic activity going on in 2024, but it doesn't have to be 2 years of some kind of crisis happening. It could just be where the economy just slows down enough to kind of have negative growth for a couple quarters.
Yeah,
Scott,
a recession is normal part of a market cycle, right? Are we going to have one? Yes, we're going to at some point. You can't not have a recession at some point. But my thought is that this will be the most telegraphed and shortest lived recession in the history of recessions. I mean, we've been hearing about this for what, a year and a half, that it's going to happen, and it hasn't happened yet. So, will it happen eventually? Yes. But I mean, working with the companies that we work with and people that I talk to, every company battening down the hatchets waiting for a recession is sitting on either PPP money or employee retention credit money, or I guess my point is corporations have cash that I believe they will deploy as soon as they believe recession has hit. And as a result of that, I think it will be a short recession and not a very deep recession, but to be determined, I guess.
Yeah, it does look like that because, again, going back to COVID, during COVID, a lot of companies got lean and mean, and it seems like corporate America is like that right now. So it wouldn't seem like and sometimes when you have these, more serious recessions, they're usually preceded also by some kind of big financial crisis. And it doesn't seem like we're in that mode right now. Things look okay. So I would agree. I think that, we'll probably have some kind of short-lived recession. And recessions happen, again, just like bear markets do in stocks, because we just get overheated. Things go up too long.
And it's opportunity. I think it's opportunity too. I mean, if you're a long-term investor, it's an opportunity to take advantage of fear in the market, right? Because investors can digest positive information and they can digest negative information, but recession is more the fear of the unknown, and that's an opportunity. When there's fear, you take advantage of the opportunity.
Absolutely, because the only reason that wouldn't be true is if we never went back up again, with either the economy or the markets.
And then we're all in trouble.
So, what do stocks? How do stocks react to recessions? Well, they're usually going to be a leading indicator. So, like we've had in 22 and 23, we've had a little bit of pain in the stock market because the market's sort of looking out and saying we're sort of predicting we are going to have some slower economic growth. The good news is that once the recession hits, the market actually starts moving up. because it's now the market starts predicting that we're coming out of the recession at some point, and so it starts looking ahead. And pretty big gains. And again, going back to your point, Scott, you don't want to be out because the gains will happen very quickly, when they happen. And this chart's just showing what happens during recession. GDP is economic growth that's negative during recessions. But if you look out 1 year after, 3 years after, 5 years after, you have some pretty healthy gains in the stock market going past recession. So you just want to be there. You want to be out because you're going to miss out on some of those gains. This year, like we mentioned, what they call the Magnificent Seven, again, Apple, Amazon, Nvidia, Microsoft, Google, et cetera, have driven almost all the market performance. This chart, that top line that you see is the Magnificent Seven stocks gains this year. And the bottom are the rest of the 493 stocks that are in the S&P 500. So we've had the most narrow market, the biggest difference we've ever seen with just a few stocks driving everything else. And that's going to reconcile itself. And you see those red arrows on there. Something has to happen. Either you have to have that bottom line start moving up towards the green line, or that top line's got to start heading down. And maybe it's going to be a little bit of both until they meet again. So,
yeah, the Magnificent Seven. What I think about that is kind of crazy. Is I can't remember what I read. It's 70 to 75% of the gains for the Nasdaq have come from those 7 stocks for the year. So it's an extremely large number from a very narrow group of stocks. But my thought is a rising tide raises all ships. Everybody will see the Nasdaq is up, and you'll start seeing investors push money toward Nasdaq type stocks, and other stocks will start participating over the next few years, and that's why we're heavy tech right now.
Yeah, and because eventually what happens is everybody owns Apple, right? So they're done buying Apple and they have money to say, what else do I buy? Because I'm not going to have all my money in Apple. So that starts broadening market performance out. So that's usually what happens. The last time that we saw a narrow market like this, where there were just a handful of blue chip names dominating, was back in 1999 and 2000. And on the one side, left side of this page, you see the largest 10 companies that were in the S&P 500 back at that time in 2000. And which was Microsoft, General Electric, Cisco, Walmart, Exxon, Intel, Lucent Technologies, which a lot of people would say, who the heck's that? IBM, C is for Citigroup, and America Online, which and a lot of people from now would say, what is that? So, as the years pass by, there's only 3 of these stocks that are bigger, as far as market cap is concerned. They got bigger over time. That would be Microsoft, Walmart, and Exxon. All the rest either shrunk or no longer around. Lucent's no longer around, and AOL shrunk to almost nothing before it got sold. Relatively speaking, nothing. It went from 158 billion to 4 billion. So you look at today's stocks, and as unlikely as it seems today, there may be a couple of these or a handful of these that shrinks actually over the next 10 years or gets smaller, or maybe it's not even around. I mean, it could happen. And the point is that you don't want to just have all your money in just a few stocks. You do want to have your money diversified. And in our portfolios, our equity portfolios, yes, we are overweighted in technology, which has helped a lot this year, but we also have other investments in other areas. And, we're probably going to out in the next 6 months, a year, be diversifying out even more, because other places will do better during recessionary times, assuming we have it. One other topic before we're going to go back to the recession here, but, higher rates, which again, if you go back to what the Federal Reserve has been doing, they raised rates off of 0 to 5.5% over a very short period of time, about a year, a little bit over a year and a half. And that had a negative effect on stock prices. It also had a negative effect on bond prices and mutual funds and ETFs, but it has a positive effect, which we're seeing for clients. And that is that rates are higher off of 0 that we can get in individual fixed income. So we can buy things like corporate bonds at 6 to 7%, and buy other things like treasuries at 5 to 5.5%, that for a very long time we couldn't buy it. And those are low risk investments. So for savers and older people, this is a good thing. It has some negative effects, but it also has some positive effects that we've been able to generate for clients too.
Yeah, anybody that's got fixed income as part of their portfolio, this is great, because it basically means we can target whatever. If we're targeting an 8% return on your portfolio, we can have a little bit more in fixed income and still hit that 8% because fixed income is actually generating something now. And we can, lower the overall risk of your portfolio and still kind of get those target rates that we're trying to get. So this is a good thing.
Yeah, Paul, it's an excellent point, Paul, because I have some clients that are in their 90s, and prior to 2022, I probably had more equity exposure than I would like to try and generate return, because I couldn't get anything in fixed income. If you're at zero bound rates, you're not going to get a whole lot, in fixed income. So now it's just the opposite case where I can buy again 5 to 7% kind of rates of interest, and not to have to be so invested in equity for the older investors. For younger investors, this doesn't really mean a whole lot because they're going to be invested more in equities anyway.
So I agree with that. But for savers, this makes perfect sense for the retired generation, maybe that are taking distributions already. I totally agree. What the question I've had, and where I've seen a little bit of interest that I don't think makes total sense, is younger people saying, not younger, but well, it's my age, 40s, 50s, those younger people in my generation.
That's younger.
That's younger. So those people saying, I can go get 5% of the bank or 6% of the bank, and considering taking money out of the market. And my thought is, if you're willing to have your money invested through a market cycle, call that 3 to 5 years, a stock market cycle, it still makes more sense to have that money invested in the market relative to something CD oriented or bond oriented. So I think we need to just work between the two, right? So for, if you're distributing now, and this is a great way to get 5 or 6%, totally agree. But I guess I don't have as much enthusiasm toward taking money from the market if your market cycle or your distribution cycle is more than 3 to 5 years.
Yeah, and that's a good point, because over time, the 5% on fixed income is about what the average is over long periods of time, for fixed income investments. The stock market does double that, right? Over time, stock market's doing something 9 to 10%. So for younger people who are going to be invested for 15, 20, 30 years more, it wouldn't make a lot of sense as long as it can handle the volatility going up and down. It doesn't make a lot of sense for the growth of their money just to stick all their money into something like a 5% kind of fixed income, for sure.
You see how I lump myself into the younger people at 47 years old?
Well, you questioned it, and that's why I had to reinforce that. No, you're still young. You're still okay. You may not feel like
as you get older, the younger group keeps getting older too. So
it's all relative. Someone who's 90,
it's all relative.
You're like a baby. All right. So for 2024, what do we see? For sort of macro level, we see a battle coming between the Federal Reserve and Congress, because next year is a big election year. And usually what the politicians want is they want the economy juiced up. They don't want recession, because if things don't look good, people will go to the voting booth and they may vote for the other person instead of the person in power. So they try to do everything they can to put pressure on the Federal Reserve to cut interest rates, and and with lower rates, people will borrow more money. There's more economic activity that goes on with lower interest rates. So there's going to be, and yet you have Jay Powell and the Federal Reserve who keep saying we are not even thinking about cutting rates. So there seems like there's a battle looming here shortly to see who's going to win this battle. And our guess would be Congress probably wins the battle and puts enough pressure on at some point next year to have the Federal Reserve cut rates. And lower rates, again, are good for the economy and good for stocks and bonds. Looking out longer term, if we go past 2024, looking out maybe over the next cycle of 5 to 7 years, and maybe even beyond that, we do see higher interest rates relative than what we saw the last cycle. Again, the last cycle from 2009 to 2021, we saw just about near zero rates for almost that entire time period. We don't see us going back to that level. It doesn't mean we see 10% interest rates, but we certainly could see rates in the 3 to 5% range. And that does impact markets, and it impacts what goes on in the economy. There's certain investment sectors that operate differently and better in higher interest rate environments. And even though right now financials and banks don't look good, We think financials and banks is probably a good place going out over the next number of years. Actually, some of the good technology companies also that are high cash generators that don't rely on borrowed money, they do very well. Consumer staples do very well. Companies like Procter and Gamble's of the world, Kraft Foods, that are also big cash generators, are also, you know, companies that do well during high interest rate environments.
And Michael, I'd add, like, banks are in the interest of, I mean, their business is to make money. Banks make money. And it's been very difficult for them to do that over the last few years with interest rates so low. But as interest rates rise, they can increase spreads. And when we're thinking of our investment allocations and that sort of thing, we're looking at, on the stock side, overweighting financials a little bit, with the thought being they can increase spreads and make money that way. And they're going to take advantage of that. So, I mean, look at it this way. The 1-year CD at 5% that we're talking about is great, but mortgage rates are now up to 8%. I mean, that's a 3% spread on saving versus borrowing. And that's how banks make money. So I think it's an opportunity going forward in our stock portfolios.
Yep, for sure. That's a sector we're looking at starting to, at some point, overweight. Also, industrials are another area. Companies like Caterpillar, you know, especially with the government spending the money like they're spending. Now we have some pretty big deficits, but you know, the government is spending money, and there was a big infrastructure program that was pushed through. You're going to start seeing some of those companies benefiting from that. Also, energy is another area. You know, we were at one point, which is why we did really well in 2022 relative to the markets. You know, high, you know, very overweighted in energy at that point in time. We cut back on energy, which was smart this year because it's down. But that's another area we're looking at that also benefits with higher interest rates. All right, any you know, our goal, keep making money for you. That's what our goal is, and we keep looking for different ways to benefit from changing market conditions and what's happening out in the marketplace. Any other last comments you guys have?
No, I'd agree with that. I mean,
really-
we meet every Monday and talk about this stuff, and I think it's very important that we're in the right spots, and I feel like we're where we should be right now, and constantly looking at it to make sure we continue to do that.
Yep, and you know, we'll see. We'll, you know, again, every Monday morning we have our investment committee meeting, and talking about investments and how to keep making more money for people and how to be in the proper investments. So we'll keep doing that for you.
And we're always available to anyone that wants to talk about it. Yeah, always available to bounce ideas off of, or at least get our opinions on, anytime.
Yep, absolutely. Paul, anything last?
No, I would agree with all that. And we appreciate you taking the time to watch this, if you've watched this. And we'll be back to you again with more stuff. And like Scott said, reach out to us anytime. We're here. So thank you, guys.
And we'll see you early next year.
Yep, sounds good.
Very good. Be well.
Bye.